This is your Wall Street wake-up call. The Bank of Japan leaving key interest rates unchanged following its policy meeting on Thursday. I'm joined now by Steve BLITZ, the chief economist at ITG. So Steve, this pushing the yen to an 8-month high against the dollar, what does this tell you that the Bank of Japan sort of sat on the sidelines this time after pushing rates into negative territory back in February?
Yeah, I think, first of all, exactly what they said. I think they want to wait and see what the impact of their actions are. You know, monetary policy, regardless of the nation, takes anywhere from 12, 18 months before you really begin to see the impact of it. And it's really much too soon to see whether or not they're going to get out of this move what they want, which is, in terms of the negative rates, which is really an increase in borrowing and leverage spending, which would help boost production and expand production, but they have to have product to sell, and they need a currency to sell it in. So it's a complicated calculus, and sometimes it does pay to just simply not listen to the markets and simply wait and see what occurs.
But negative interest rates, is that the right path for them? Did you agree with that decision back in February?
Personally, I don't think it's the right thing to do. I think at a certain point that, even in the United States, you're really starving people in terms of their earnings on their savings. And Japan's notoriously, maybe that's not the right word to say notorious,
right,
but it's a high savings country. And you also have an aging nation, so you have a lot of senior citizens who are really starved on their spending that much more because of how little they're earning on their deposits. So if you really want to begin to create a domestic bounce, you really have to give people some return on their income. The other choice, obviously, is for them to be the old Japan Inc. and be net surplus country and exporting all over the world. But you have to remember, in the 1980s into the 90s, they moved a lot of manufacturing production from Japan into China. So, how much they're going to really be able to export actually from their shores as opposed to from their firms manufacturing elsewhere, including Japanese car firms manufacturing here to sell into the United States.
I want to shift and talk about the yen. Take a look at this year-to-date chart showing just how much steam the yen has gained against the dollar and how much steam the dollar has lost against the yen. This is not what the Bank of Japan wanted. So can you have a successful monetary policy when the yen is a safe haven currency?
Well, it does make it a little bit more difficult, but then again, I'm not exactly sure whether or not cheapening the yen is really the be-all and end-all of where they want to get to. Certainly they don't want a non-competitive currency, and I'm not so sure that in terms of the macroeconomics, whether the difference in price from 114 to 108 is really that meaningful if you are a manufacturing firm where the currency is an important component. And like I said, a lot of these companies, these Japanese firms do manufacture, like the United States, they do manufacture globally to sell into domestic markets.
And just quickly, do you think we'll see another rate cut by Japan this year?
I think, to be honest, I think it depends very much on what happens with the Fed in June. If the Fed goes and tightens, that's going to give them a de facto ease, which will help their currency. So I think, and their next meeting is after the next Fed meeting, so I think that's probably on the calendar the most important thing.
All right, we'll be watching. Steve BLITZ from ITG, thank you so much for coming in. I'm Scott Gamm, and you're watching The Street.